Welcome. Now for something totally different. We were gifted the Sangha trading indicators back in the year 2011 when in January, after we tried to go live using Bollinger Band MACDs to trade the market, that it was too discretionary. So I've asked the Holy Spirit to give me something simple and understandable and teachable, and something that would allow us to trade the market profitably. Well, 4 years later, we're still at it with the Sangha trading oscillators. After 1 year, the very basics of the oscillators were given to us. Essentially, it's just a MACD. And here we're using a MACD of 6, 12, and 9. 6 fast, 12 slow, and 9 for the exponential moving average. And then from this MACD of 6, 12, and 9, we got our prime, which is calculated as the difference between the fast MACD, the difference between the previous bar, so current bar minus the previous bar of the fast MACD. The fast MACD is this dotted blue line. Slow MACD is this solid line. And from there we get the prime VLOT, which is this yellow-orange line. And then back in 2014, we derive the prime in VLOT from the prime. And the prime in VLOT is just a prime, the current bar minus 5 bars back. See, 5 bars back, offset. Now, with that magic formula of the current bar minus 5 bars back of your prime, you got a fast line, which is the prime in VLOT, the dotted yellow-orange. The dotted yellow-orange will move faster across the zero before the prime does, and acts as a predictor. So, what do you have in front of you? I was faced with a vexing question this month, the month of February. Now we're going into March. A salesperson approached me and asked if I would like to place half of my retirement funds to be managed by his insurance company. And the way that they were going to manage it is with a 60-40 split, where 60% of my retirement funds will be invested in equities, similar to the S&P 500, which is 500 strong companies represented by the Standard & Poor Index. And I was asking the Holy Spirit, dear Holy Spirit, is it wise for me to go back into equities? And the Holy Spirit gave me the answer, essentially telling me that I've already given you a means to find out that answer. And what was that means the Holy Spirit gave me? Using the STO, the Sangha trading oscillators, to get a feel at where the market cycle is for the S&P 500, for the equities. So what I did is I went into Yahoo because I couldn't easily go into Google to get this information. So I just typed in Yahoo Financial, and went to market data, and there you are, S&P 500. So click on the S&P 500, go to historical prices, and I ask it to dump into the spreadsheet the monthly prices. And there you go, all the way back from 1950 to 2015. So here are the monthly closing prices of the S&P 500. So from here, I dumped it into a CSV file, which is a comma delimited file in Excel. And you have to sort this first before you can open it up in Sierra Chart, because Sierra Chart needs to see the oldest dates at the top. So here we are, go to data, go to sort, and you would sort it by date, oldest to newest. So once you've sorted it, then you save it to a file. And the file I saved this to is the following. I saved it into the file SNP upper caret GSPC, and I gave it the current data when I did the dump. And Sierra Chart can open up CSV files, and this is a comma delimited or comma separated file. So that can be opened by Sierra Chart. Let me delete that because I don't need that. Well, apparently I can't delete that. Come on, why can't I delete it? There you go. All right. So once you've got the comma delimited file, you then open up Sierra Chart by saying open historical chart and choosing the comma delimited file, and then applying the analysis Market Watch. I've got all of these, the Market Watch study saved in the harvester.zip, as well as the Market Watch chart file saved in the harvester zip. So you can get at it and look at it yourself. So what is the answer that the STO oscillator, the Sangha trading oscillators give us to the question of should I go back into the equities market so that I can have this company manage my retirement fund with a 2% fee on the total monies that they're managing? And if you were to look at the MACDs are these blue lines. Again, the fast MACD, the dotted, and the slow MACD, the solid. That's here we are. The housing bubble collapsed back in 2008. And when that housing bubble collapsed, you'd notice that the MACD bounced off the upper mids. That's the upper mids, that's the lower mids. And when it bounced off the upper mids, the prime VLOT crossed past the lower danger zone. And you already know that something is up because the pin VLOT crossed down into the lower danger zone towards the lower mids ahead of the prime VLOT. So the pin went down ahead of the prime VLOT. So that already told you that the market was going to go down. The S&P 500, a measure of the equities market, was going to lose value. And also at this time, if you were to look at the bottom chart, this is a short-term government mutual fund, the Fidelity FFXSX, short-term government bonds mutual fund. And you would notice that during the housing crisis, as the prices of equities were beginning to go down, bouncing off that upper mids right here, the bond market crossed up, the MACD of the bond market crossed above the zero. And of course, it was led with the prime VLOT and the pin VLOT strongly together, going up towards the upper mids. So, bottom line, if you were to do a market watch, watching the market in terms of its overall performance, what it's going to do, and using the bellwether, the canaries of the S&P 500 and the short-term government bonds of the Fidelity FFXSX mutual funds, you will notice that when you get this behavior of the bonds crossing up through the zero of pins and MACDs, and the S&P bouncing off the mids, and the pin and the prime going below the lower danger zone, yeah, the market, equities market, is going to tumble. Boom, it tumbled as the bond market continued to go up. And even though the equities finally recovered back to its original value back here by 2013, you notice that the bond market continued to go up and finally began leveling off and beginning to bleed. Now, you could also tell that something's happening with the market when the 5 EMA crossed down below the 40 EMA. But that gives you a very late indicator. Look at where that cross happened and where the S&P MACDs are. That's much too late. You'd want to be warned earlier. Right here, you'd want to be warned when the prime of the S&P 500 goes below the lower mids. That's telling you, oh, get out of equities and go into bonds. So here we are, February. February 2nd is the last monthly read on the S&P. And as you can see, we've been sustaining an uptrend for quite a while on the equities. And the troubling part is that the prime is no longer just staying above the zero, telling us that the market will remain on a positive climb. It's now below the zero, telling us that the peak of the market has already been reached. The peak of the equities market has already been reached. It's not ready to precipitously fall yet because the prime of the S&P 500 hasn't gone down below the lower mids. But it's telling me that this is no time to invest in the equities market and to give half of my retirement to be managed where 60% of it is going to go into stocks and 40% into bonds, because the 60% is going to be lost when the market cycles back down again. And we know that the market will cycle back down again because the market is just cycles upon cycles. Look at this example. You bounced off the upper mids, went down to the lower mids. You had the crossings of the fast and slow MACDs. You went back up to the upper mids, and we've been above the zero all this time. And you know that it's got to go back to the zero. So why would I trust this company to take half of my retirement fund and invest another half of it, more than another half of it, in equities, which is going to be lost in the near future, especially as this prime and pin of the S&P monthly 500 begins creating a V and heading down towards the lower mids. Now, if the S&P is not enough to be believed, look at your bonds. The bond is our sanity check, because we know that the bond will need to cross above the zero if the equities are going to go down towards the lower mids. And what do we use as an example of this happening? Back here during the housing crisis. Because back here in the housing crisis on January 2008, you see that the MACDs of the bonds crossed above the zero, and the primes were well outside the upper mids. The pins and the prime. The pin and the prime outside the upper mids, as the pin and prime of the S&P 500 equities goes below the lower mids. And what do you see here currently? You see that the bond MACDs, short-term government bond MACDs, are ready to cross the zero. You don't have convergence yet or togetherness yet with the prime and the pin of the bonds. But when that happens, you know that the equities market is going to go down and go down hard. So once again, I've gotten my answer from the Holy Spirit on should I allow this company to put 60% of half of my retirement savings into equities? The answer, given the Sangha trading oscillators, is a definite no. Now, does that mean that I can't go into equities ever? Of course not. I should go into equities when I see this pattern happen once again after the market crash. The market will crash But